Knowing whether a company's share price is currently overvalued or undervalued compared to the real or intrinsic value of said company can help you earn greater returns on your investments. The price to book ratio, shortened to PB ratio, compares the market value of a company to their book value. Before we get into how to calculate the PB ratio and what the price to book ratio means, what the heck is a company's book value? The book value of a company is a fundamental metric used to express the net asset value or NAV. This is the total assets minus intangible assets and liabilities. Intangible assets are simply assets which the company does not have complete control over, as they are not physical in nature. As an example here, real estate is a tangible asset as it physically exists, but on the other hand, stocks and bonds, as their value is agreed upon on paper or contractual terms, they are intangible assets. Another way to picture the book value of a company is similar to the intrinsic value. If a company was to sell off all of their assets and pay the entirety of their debts, the book value would remain. You can calculate the price to book ratio by dividing a company's price per share by its book value per share, or BVPS. You can find the book value per share on the balance sheet under the Statistics tab on Yahoo Finance. It would be an extra step to do this, however, as the price to book ratio is already listed on the statistics page of Yahoo Finance under the valuation measures. A lower PB ratio, especially a price to book under 1, generally means a company is undervalued by the market and is a good opportunity for investors to grab some extra returns. Beware here, however, as you must do your due diligence on the other fundamental metrics to ensure no reason is present as to why other investors have been staying away and the share price is so low. On the other hand, a higher price to book ratio can signify a company is either expected to grow respectively in the future, or that said company is overvalued. One way to distinguish between the two here is also by looking at the return on equity, or ROE. We will talk more about this fundamental metric in the future. Subscribe to get notified on that. But if a company has a high PB ratio and a low return on equity, this may signify that they are overvalued, as the company is not increasing business operations alongside their increasing share price. If you enjoyed this segment of Fundamental Fridays, where we look at a different fundamental metric each week, please subscribe to the channel, turn on notifications, and check back next week to further your fundamental analysis. Don't forget to smash that like button. As always, I'm Patrick Zimmerman. Thank you for your time, and have a nice day.